Journal entries are like a special diary for a business's money. They keep track of every dollar that comes in and goes out. This careful recording is important for understanding the financial health of a business. Think of it like keeping track of your allowance. You write down when you get money and what you spend it on. Journal entries work in a similar way, but for businesses. They help businesses see where their money is going and how they can manage it better. Just like you can see if you're spending too much on candy by looking at your allowance tracker, businesses can see if they're spending too much on certain things by looking at their journal entries. This helps them make smart decisions about their money. These entries follow a specific system called double-entry bookkeeping. This means that for every financial event, 2 entries are made. One entry shows where the money came from, and the other shows where it went. This system makes sure that everything is balanced and nothing is missed. Journal entries offer numerous benefits for businesses of all sizes. They help businesses stay organized by providing a chronological record of all financial transactions. Imagine a shoe store owner who wants to know how many shoes they sold last month. By looking at their journal entries for that month, they can easily find the answer. Journal entries also help businesses create important financial statements. These statements, like the income statement and balance sheet, provide a snapshot of a business's financial health. Think of these statements like a report card for a business. They show how much money the business made, how much it spent, and how much it owes to others. Accurate journal entries are crucial for making informed business decisions. For example, if a bakery owner wants to open a new location, they need to know if they have enough money to do so. By looking at their financial statements, which are based on their journal entries, they can see if they can afford it. Each journal entry follows a specific format to ensure consistency and clarity. First, the date of the transaction is recorded. This is like putting a timestamp on the entry. Next comes the name of the accounts affected by the transaction. Accounts are like categories for different types of financial information. For example, a business might have an account for cash, an account for sales, and an account for expenses. Then, the amounts of money involved in the transaction are recorded. One account is debited, meaning money is added to it, and another account is credited, meaning money is subtracted from it. Finally, a brief description of the transaction is added to provide context. This description is like a short note explaining what happened. For instance, if a business buys a new computer, the description might say, "Purchase of new computer for office use." Section 4. Importance of journal entries for decision-making. Journal entries form the foundation of financial reporting, which is essential for making informed business decisions. They provide a detailed and organized record of all financial transactions, allowing business owners and managers to track income, expenses, assets, and liabilities. This information is then used to create financial statements, such as the income statement, balance sheet, and cash flow statement. These statements provide a comprehensive overview of a business's financial performance and position, enabling stakeholders to assess its profitability, liquidity, and solvency. For example, a business owner might use journal entries to track sales trends over time. By analyzing this data, they can identify seasonal fluctuations in demand and adjust their inventory levels accordingly. Similarly, journal entries can help businesses monitor their expenses and identify areas where cost savings can be made. By tracking expenses by category, businesses can gain insights into their spending patterns and make adjustments as needed. Section 5. Best practices for maintaining journal entries. Maintaining accurate and reliable journal entries is crucial for effective financial management. One best practice is to establish a consistent recording process. This involves using standardized procedures for recording transactions, such as using pre-numbered journal entry forms or implementing an electronic accounting system. Another best practice is to ensure that all journal entries are supported by proper documentation, such as invoices, receipts, and bank statements. This documentation provides evidence of the transactions and helps to prevent errors or discrepancies. Regularly reviewing and reconciling journal entries is also essential. This involves comparing the entries to bank statements and other supporting documentation to identify and correct any errors or omissions. By implementing these best practices, businesses can ensure the accuracy, reliability, and integrity of their financial records. This, in turn, will lead to better decision-making, improved financial performance, and increased stakeholder confidence.